All right, good afternoon, everybody. My name is Bobby Rains. I'm here for our once every 3 weeks members only workshop from Investors Observer. Thank you all for coming. Here is our agenda for today. We're going to look at some charts. We'll talk about what else is happening. We'll look at what sectors and industries in the market are hot right now. And then the rest is member-driven content, questions, site demonstrations, whatever it is that those of you who are hearing my voice right now are interested in, we can do it. So that said, at any point, now or later, if you have a question, you can go ahead and put it in the question box. Otherwise, you can also submit them ahead of time. Thank you to the people who submitted questions ahead of time. All right, so let's look at some charts. All right, the S&P 500, we went out at the lows today. Turns out I didn't capture this at exactly 4 o'clock. We went out at the lows today. I captured this toward the end of Powell's speech. So we'd gone up and then back down, but not all the way down yet. We've come up here. It is interesting that this support line from here and support resistance line from here and here and here and here a little bit served to sort of turn us around late last week and earlier this week. We'll see how the rest of the week shakes out. Trading in Fed weeks is always tricky. My guess is, if I had to guess, my guess is that today's slide would probably hold for at least a little while. But we will see. It doesn't necessarily mean down tomorrow. I just don't think we're going to get back above, say, Monday's open before Friday. But we'll see. Trading on Fed weeks is terrible. I don't know why anybody does it. But that's my guess. All right, the NASDAQ looks a little bit worse. It hasn't come back up quite as far, which means it's, hasn't gone, I guess it has gone down about as far, but it's not as, it just doesn't look as good. We'll talk about why as we go through. It's still in this pretty tight sort of channel here. Like to see it hit the bottom here and then break out to the top, but we will see if that actually happens. The Russell kind of looks the best. Obviously, today's candle is not super exciting, but in terms of just steady progress upwards without, these two candles could be seen as kind of a retracement a little bit and not so much a reversal. I mean, if you look at, say, this rally here, you see some down days, right? Like a rally won't be all green days. Whereas here, where we go up and kind of stop and then come down, that looks much more like a reversal to me than something like this. Really, I think the tomorrow candle probably tells the story here a little bit better. So those are the major indices. S&P 500 equal weight continues to outperform the cap-weighted index. This is again a story about big tech, right? Those big tech companies at the top of the S&P 500. Even though earnings season was not bad across the entire market, the big bellwether companies did not do so well. So that's why the cap-weighted index is not doing as well as the equal weight index, because the equal weight index includes a lot of the companies we see, broken out here. Growth really has sort of accelerated away from value. Value has kind of accelerated away from growth to the upside here. And again, value stocks tend to be more mature companies. A lot of times they pay a dividend. They tend to be slower growing. Right? They're unlikely to grow 10 times over any number of years, like we have seen from tech stocks over the last several years. But they're also tend to be less volatile. And in the case here, and what we'll talk about a little bit later, is they tend to be, one, less exposed to interest rates, but also less exposed to sort of markets or economic cycles outside of interest rates. All right, the sectors and industries that are hot right now. Before we get into this, you can find this any day you want on the website. That's not where it's supposed to be. All right, stock, sector, and industry. The data lives here. You can look at it for any of our scores. What I use for this presentation is the short-term technical score that shows how the market has been doing over the last, say, month or so. So remaining at the top of the pack are the energy sector and the thermal coal industry, followed by oil and gas drilling and exploration and production. I don't think that really requires a lot of explanation. We came back from the pandemic faster than energy production could ramp up, and then Russia invaded Ukraine and threw the entire global energy market into kind of a tizzy. So, right, coal is up there partially because it can be a substitute for natural gas in the sense of a lot of electricity production. And then, yeah, oil and gas drilling and exploration and production are the other, just the other ways we get energy for a lot of things across the economy. Utilities remains in number 2. The order of the sectors here changed a little bit. Independent power producers, those are basically companies that are running a power plant that aren't actually providing that like last mile service to anybody's home. Essentially, imagine a power plant that just exists somewhere and it sells power to your AEPs or Dominions or whatever your power company is, typically in times of peak demand. And then the diversified utilities is that last one. It seems like there should be some other thing there, but it's not. And that really is some smaller grid operators and some other, companies that don't get most of their revenue from one sort of definable source. Well, yeah, these are interesting because one, they pay a dividend. They're typically cash producing. Utilities can be a little bit interest rate exposed, right? Like building a power plant is the kind of thing you tend to need to borrow a lot of money for. The other side of that coin, though, is in a recession, people tend to keep paying their power bill, whereas some other bills they may try to cut down on, cut spending other places. Right, those utilities are a thing you keep paying. So it's a little bit interesting to see utilities here just because they fit with the, people are looking for defensive plays in the equity market narrative. They fit less well in the interest rates are rising narrative, but that's kind of where we are right now. This whole thing is a little bit mixed in that regard. Basic materials is next. Paper and paper products. There's a couple mergers going on in that space. I'm not 100% sure why it has been doing so well recently beyond that. Just generally we use a lot of paper now in terms of shipping, so cardboard boxes, things like that. I think it's more of that than like, more traditional ways that we think of paper in terms of, reams of copier paper. Coking coal, which is the coal that's used in steel production, and then steel. Again, these are interesting, right? Paper and paper products. Like I said, I have a hard time explaining exactly what the story is as far as that one goes. But the coking coal and steel, we don't typically see a lot of demand for steel when the economy is weak. So it's kind of interesting to see that been doing doing well there. But yeah, like I said earlier, we're kind of in an interesting spot now. Consumer defensive. This is another place where people go to put money when when they're worried about stocks. Confectioners are things like Mondelez, I think Kraft, Smuckers, your General Mills, Kellogg's are all in there. Food distribution is not exactly the same, but not too dissimilar, right? It turns out that people want to eat regardless of how the economy is doing. And tobacco, again, not a growth industry, but it does remain a it's a steady business, and sort of because it's not a growth industry, those companies tend to pay a pretty solid dividend just because there's not a lot of research and development being done at this point. They might as well just toss the profits back to shareholders. So again, right, like if we're looking at a recession narrative, consumer defensive makes a lot of sense as far as that goes. And then we follow it up with industrials, infrastructure operations, airports and air services, conglomerates. Again, these are the companies that you would expect to be like, right, like think about, I remember, recessions, any recession past, right, like factory workers and big industrial operations typically lay off workers, but those stocks are doing well. Those companies are doing relatively well. And keep in mind, this includes a good chunk of earnings season. I think more than half the S&P 500 has gone at this point, maybe 2/3 that's reported at this point. So this is a pretty significant amount of third quarter earnings data, and these are the companies that have done well. So it continues to be, because I think I said this last time, a pretty mixed story in terms of what this data is telling us. On one hand, we have people looking for safety and sort of quality and cash flows, and on the other hand, we have a lot of things that we would expect to be doing well in a growing economy. All right, what the Fed said. The Fed, concluded their meeting this afternoon. As sort of everyone expected, they raised interest rates by another 75 basis points, which is 3/4 of a percentage point. This italicized bit at the top is kind of the big new sentence. They put out a statement every 6 weeks when they meet. And a lot of times it's basically the same. They'll change a few things here and there. This big chunk was essentially the new bit. And the market originally interpreted this as being pretty sort of dovish and pointing toward maybe not a softening in policy, but some kind of a pivot, which is the word that everybody's been using. And essentially, right, the committee will take into account the cumulative tightening lags with which monetary policy affects economic activity, inflation, etc. Right, I think people really focused on, cumulative tightening, right, the interest rate hikes to this point, and the lags, right, because you don't raise monetary policy today or raise interest rates today and see the effects in the economy tomorrow. There's some lag there, and so that is that's kind of interesting. Just because they are acknowledging, hey, we've already raised rates a bunch. We might think about slowing down. So the market's initial reaction to this was pretty bullish. Stocks were up. Everything was kind of acting like the Fed was maybe going to slow down. But then the press conference started and things obviously went the other way. This statement does sort of seem to be setting the table for smaller hikes going forward. But the Fed is really interested in not painting themselves into any kind of corner. I think they would rather, and Powell said in the press conference, he'd rather miss by going too high than easing too soon. And so, right, I think that's probably accurate. I also think that is signaling to the market, right? Because every time the Fed does something and then stocks go up, right, what the Fed is trying to do is tighten financial conditions. And stocks going up and interest rates falling and all of those things that happen in a market rally is financial conditions essentially loosening. So if you're trying to tighten financial conditions, you can certainly do it by raising interest rates, but you also have to do it by sort of tightening sentiment, if that can make sense, right? Again, higher stock prices are looser financial conditions. So it's an interesting thing you kind of have to do there to get that to happen. Powell also said the terminal rate, which essentially is the sort of ultimate peak for this cycle, is probably going to be higher than previously estimated. I think in September, when the Fed's, the economists released all their projections, it was somewhere in the 4.75 neighborhood. And now people are expecting something closer to, 5. Ultimately by maybe next year. Maybe by the end of next year, we'll see. But yeah, the game here is unfortunately sort of both interest rates and also signaling, because people are always trying to essentially sort of figure out what the Fed is going to do so they can get ahead of it, right? I mean, it's any kind of market thing, right? Like if you can try to predict the future, you'll do well in the market. So people are trying to sort of guess what they're doing here, but because the Fed is trying to tighten financial conditions, they really want to hammer home to people, we're going to keep raising rates and we want things to remain tight because the economy hasn't slowed down to a point where inflation is sliding yet, or sliding very much yet. And so we're going to keep doing this. And so they kind of have to keep going through both the policy channel of raising the actual rates, but also the messaging channel of we're going to keep raising rates. All right, so just in context, yes, interest rates are the highest they've been since, sometime before 2010. But in the broader contrast of interest rates, they're still not particularly high. Certainly if you look at the mortgage market, mortgage rates are higher here than they were here. Even the spread between the Fed funds rate and the mortgage rate is higher now than it was, and there's a lot of sort of technical reasons for that. But broadly speaking, interest rates are not super high in a historical sense. A lot of the economy is different since, times when interest rates were very high. But, all of this period we were dealing with persistently low inflation. The Fed and the economists couldn't figure out why inflation wasn't happening. And now we have it going in the other direction. So it's maybe not, I think perspective is important in terms of things like that, just because it is, certainly it's the highest they've been in several years, but they're not particularly historically high. All right, so we have a question. So why did Treasury yields move in the opposite direction of stock prices, both up and down during the Fed news today? So Treasury yields go up when people sell bonds, right? So less demand for bonds. The price of the bond goes down, the yield goes up. And stocks and bonds tend to move sort of in the opposite direction, at least yields and stocks tend to move in the opposite direction a lot of times. So yeah, stock prices go up. A lot of times what's happening is, people are putting money in. You say Treasury yields. I don't know exactly which piece of the curve you were talking about. Initially, short-term Treasury yields went up and also stocks went up. I didn't look at yields at the end of the day. My guess is they probably closed higher, which is not surprising because the Fed said the short-term interest rate is going to be higher. So if you think about a bond, it's a series of interest payments, right? And the interest payments are fixed as a dollar amount. And so if you buy a bond for $100 and it pays 2%, that would be $2, right? Now, the way the bond market works is usually the initial buyer, or at least the face value of the bond, right? Like we'll have $100 on it. But bonds are sold by the Treasury at auction. They're sold in a market where that price can be different. So it might be $100 worth of bond, and maybe I buy it for $99. Well, now I'm not getting actually a 2% return for that $2 every payout. Or $2 a year. It's something higher than that, right? Because I didn't actually pay $100 to buy the bond. So that's how bond interest rates change. Even actually they're issued is essentially the price of the bond changes. And so, right, but if you think about the fixed interest market as a whole, right, you have this rate, which is essentially what banks can get parking money at the Federal Reserve overnight. And then every sort of longer period of borrowing is just a whole bunch of these, right? So a 3-month interest rate is just 90, right? What you expect the average interest rate here to be over the next 90 days. A 2-year is the same thing, right? What do you expect this rate to be over the next 2 years? What do you expect it to be over the next 10 years? What do you expect it to be over the next 30 years? However, your, whatever tenor or, maturity of bonds you're trading, it's really just a series of cash flows and interest rates. And so, yeah, if the short-term rate is going to be 5% and 10 years are paying something less than that, I'm not going to buy the 10-year because I want to buy this. The reason to buy the 10-year is at something less than the current rate is you think rates are going to go down pretty soon and be lower than the current rate for most of the next 10 years. That's why the yield curve inverts, because people think the average rate over a longer term will be lower than the average rate over a shorter term. But usually that goes in the other direction. All right. So what else is going on? Complicating the Fed's issues is the economic data continues to generally be relatively good. The JOLTS report was better than expected this week. A lot of other measures are also edging out estimates. Inflation remains high, but the composition is changing. So this chart here is the Citigroup Economic Surprise Index. So what they look at is essentially economic data coming in and sort of how the reports come in compared to what the expectation was. Okay, and so when this is below zero, it means that the data is coming in worse than expectations. When it's above zero, it means the data is coming in better than expectations. So we had a period, sort of toward the end of the summer where things weren't doing so, the data was coming in worse than expected. Now we're back to sort of, data coming in better than expected. So that remains kind of a complicating factor for the Fed because they are trying to actually slow things down a little bit. But yeah, when I mean the composition of inflation is changing, right? We've seen energy prices go up and then come back down. Food prices aren't all the way back down, but they have stopped rising. The thing where costs keep going up now is in the service sector. And Powell talked about this a little bit today in his press conference. So that is, sort of how that works. But it is interesting that the composition is changing, right? It's not just the same prices for the same things keep going up. It's moved sort of through the economy. On the earnings front, earnings have generally been pretty good. There were lots of low estimates. A lot of people got out and sort of, hammered the, the everything looks bad kind of narrative. A lot of companies lowered guidance. Then the analysts lowered their estimates. And then when the company actually reported the results, they were better than expected. That's a little bit of a game that everybody plays. The real weak spot is those big tech companies. A lot of those, right, your Facebooks, your Googles, are advertising-driven businesses. Right, Facebook is also spending a ton of money trying to build a metaverse, which is whatever. I guess they can do whatever they want there. But their revenue predominantly comes from advertising, and so right, like those businesses can maybe be a little bit of a canary in the coal mine, if you will, in terms of what corporate spending looks like, right? The advertising budget is pretty easy to scale up and down, right? If I'm running a factory and I need some kind of expensive machine, I don't want to actually lower my capacity while my orders are high. So I may not cancel that order, but what I may do is cancel some advertising orders because I'm not sure what businesses conditions are going to be going forward. So, drying up of advertising can be, an interesting signal. However, my one sort of caution to that is, as growth companies, the way those companies trade is not necessarily in line with what their actual performance is. A lot of it's about the future performance. And so what happens is a lot of times you say, okay, well, they're not growing as fast as they used to be. So in some cases, these companies are still growing. They're getting bigger. Their revenue is going up. It's just not going up as fast as it used to be. It doesn't take a genius to figure out that, right, that something can't keep growing faster and faster and faster, right? Because if the growth rate explodes, and the actual growth has to be getting, just to be huge, and at some point you would just eat the world. And that has yet to happen. No company has yet made all the money in the world in revenue. So there's absolutely a limiting factor there. Companies can't keep growing faster every quarter unless, I guess, the economy were to keep growing faster every quarter. But we know that doesn't happen. The other interesting thing going on in the economy that we're keeping an eye on here is developments in China. Obviously, there's these new chip controls. How all of that is going to play out is very interesting. Certain chips and certain things for the manufacture of chips can no longer be imported to China. And that covers both things made by U.S. companies and things made by non-U.S. companies that license U.S. technology. So it's not just as simple as, oh, well, all these things are made in Taiwan anyway. We'll go buy them from the, Korean company that makes these. If they're made using U.S. technology, they can't go to China. And then also, there's been some talk, talk recently. People have been speaking about banning TikTok recently. I think that's very unlikely to happen. I don't think there's any real legal mechanism to just ban a company from doing business, especially a company that's, we have a First Amendment in the United States. I think they could possibly make some rules about where the data is stored physically. Making rules about who has access to it becomes a lot harder. And even if they did that, my assumption is, rather than shut down a big company that's worth billions of dollars, ByteDance, which is the company that owns TikTok, would find some way to change their ownership structure so it still was allowed to operate in the U.S. You move some servers around, you set up some shell company in the Cayman Islands and transfer the ownership there, and then you're probably good to go. I don't really think banning TikTok is possible, but I think a lot of talk about it could keep tech company stocks from rising a lot, particularly the ones that are either exposed to China or based in China. All right, questions. So Scott asked, how are you calculating the target return on a spread? Please use today's KKR bull put spread and example calculation. So this trade was emailed out this morning. I think it was the upgrade from the Investors Keyhole service. So this is the piece that comes out in the email. The technicals for KKR, bullish with an upward trend, support around $45. The stock is trading today at $50.45. Look at the January, here's the trade, the January 35.40 bull put spread. So what we're going to do here is sell the 40, buy the 35 for a credit of 25 cents or better. This trade has a target return of 5.26%, and the stock has to fall 20.71% to cause a problem. So let's work backwards here. The 20.71% is the difference between the stock price here and 40 here. $10, which is roughly what that is 20% of 50. So for the stock to get to 40, it's got to fall 20%. That's that. Now, the target return of 5.26%. So our target profit here is this 25-cent credit. You get paid when you open this trade because you're a net seller. The 40 has a higher price than the 35. So you sell the 40, you buy the 35, you get a net credit going in. And ideally, the way this trade works is the stock stays above 40, the options expire worthless, and you keep the 25 cents. So target return for all of our trades here is just profit divided by the amount at risk. So in this case, the target profit is 25 cents. The amount at risk is the strike width less the initial credit. So the strike width is the difference between the two strike prices. 40 minus 35 is 5, minus the 25-cent credit is $4.75. So the most you can lose on this trade is $4.75. You have $4.75 at risk. Your target profit is 25. 25 cents over 4.75 is 5.26%. That is how we got to there. All right, next question. Does it ever make sense to close a bull put spread? This is the same kind of trade we just looked at previously. Or one of the legs when the stock price greatly exceeds the sold leg. For instance, a Caterpillar November 145, 150 bull put spread for 46 cents in October. Cat's now over 200. Would it make sense to sell now or wait until expiration? So in this case, it absolutely makes sense to close it now. I looked at this earlier. You can close this for probably 2 or 3 cents. So that means that instead of making 46 cents per share, you're going to make 42 or 43 or 44 cents, depending on the price you manage to get out at. Right, and it's relatively negligible, and it's 17 days today. I guess tomorrow would be 16 days until October expiration. So you get most of your target profit with more than 2 weeks left. That raises your annualized return. The other thing it does is it frees up capital that can be reinvested ahead of schedule. So it absolutely makes sense as a practice to do there, right? If you can get most of your profit in less time, a lot of times that makes a ton of sense. Now, the thing that I would look at here is not, okay, is the stock 40% or 50 or 35? Don't look at the difference between the stock price and the sold leg. What you really want to look at is the cost to close the trade. Because, yeah, if the stock is up 45% and you're going to have to pay 25 cents to get out, well, that's more than half your target profit. I don't know that that necessarily makes a ton of sense. The other consideration would be fees paid on closing. Most brokers have gone to zero commission now. A lot still charge a little bit on option trades, whereas an option expiring worthless, which is the sort of goal here, there's no commissions there. So do I want to pay, $20 to get out of a trade where I'm only going to make $40? Probably not. I would probably rather hold that for a couple of weeks. And so, yeah, right, like getting out 1 day early because you can get out cheaper, that doesn't make a ton of sense to me either. So it's really that sort of combination of what percentage of your profit are you going to walk away with and how much time is left. If you're going to walk away with most of it and you're saving a lot of time and you can, put that capital back to work, it absolutely makes sense to close the trade early. If you're walking away with a small fraction of it or, a small fraction of it and you're not really saving very much time, in that case, it might make more sense to just hang on until, the whole thing closes. All right, so Thomas asked, what is a delta neutral strategy? Some option house seems to tout this type of strategy in the 90s. Is it an outdated strategy? It's not really an outdated strategy. Delta is one of what people call the Greeks in options or other derivative trading. And essentially it's the amount of price change in a derivative, in this case like an option, for a change in the underlying. So for a delta of 1, typically that means the derivative will gain $1 for every dollar gained by the underlying. a deep in the money call option will have a delta of 1. A delta of 0.5 means the derivative will gain 50 cents for every dollar gained by the underlying. This is typically pretty much an at-the-money option. Something with a very far out of the money strike price, that's going to have a very low delta, sometimes 20, 30, or even in the single digits, depending on how far out of the money it is. Puts, the delta is negative. So a deep in the money put, if you think about it, right, a put is a bet that the stock will go down from the bought side. And so for a deep in the money put, you're going to lose $1 for every dollar the stock goes up. Okay, so a deep in the money put has a delta of -1. A deep in the money call has a delta of 1. Also, a long stock position has a delta of 1, and a short stock position has a delta of -1. So to get to delta neutral, what you essentially have to do is have a position where it's not really going to change value when the stock moves. So that means long and short the stock would be a delta neutral position. That doesn't make a ton of sense because stock borrow has some cost, so you're going to lose money there. It makes a lot more sense to use delta neutral things in option because there's time value. And so the reasons to take advantage of this kind of strategy would be to take advantage of that time decay, right? You can sell some options on one side and sell some options on the other side and bet on, tomorrow keeps happening. The time decay comes out of the options. So you're not super worried about the stock price. And the other reason to do it would be a bet on a decline in implied volatility. So a lot of times implied volatility is high around something like earnings. And so you can sell some options on either side ahead of earnings and essentially bet that the stock won't move a lot, right? So implied volatility is the volatility that's priced into an option. Actual volatility or realized volatility is how much the stock actually moves. So if the options market is priced for a stock to move 10% and you sell some options there in a delta neutral way and the stock only moves 5%, you come out ahead that way. Okay, there are other ways to take advantage of time decay. Covered calls, the sort of spreads we're doing here are all taking advantage of time decay. Now, a covered call, if you think about it, if a long stock position has a delta of 1 and an at-the-money call option has a delta of 0.5, that means that we're delta hedging to some degree in the sense that we sell that call option. It certainly cuts our delta to, potentially somewhere around 0.5 from 1. But it's certainly not delta neutral. That would be something like selling twice as many calls as we bought shares of stock, which is not even a strategy that most people can do. Yeah, shorting implied volatility is pretty sort of esoteric and risky. You're essentially betting that the market is wrong, which can work sometimes, but the market has a whole lot of smart people who are putting money in places and things get priced based on those things. So, if you really think the market is wrong about the price of some options, by all means be my guest, but it's pretty risky. The other thing about these strategies is it takes a lot of management. If you think about what I just said, an at-the-money call option has a delta of 0.5. What that means is if you buy an at-the-money call option and you sell an at-the-money put option, so the deltas cancel each other out, and the stock goes up, well, now the delta of your call is higher than the negative delta of your put, so you got to readjust because you're not delta neutral anymore. So it requires a lot of moving stuff around. It's probably a fine strategy for hedge funds and things like that that are doing a lot of automated trading with very powerful computers and have basically a bunch of people who have nothing to do but make those trades and try to get the right prices. For the retail investor, unless you really just like staring at option prices to try to roll these positions and keep them delta neutral, it doesn't seem to make a lot of sense to me. Right, we have strategies that take advantage of time decay, and by not being exactly market neutral, they tend to succeed a lot more, right? Like if you think about a lot of our strategies, the stock can go up or down, the bull put spreads, the stock can go up as high as it wants and we'll make a profit. Now we don't make as much profit as the stock goes up. That's one of the downsides of delta hedging is your return tends to be relatively fixed per trade. But the stock can move some, including a big move in the opposite direction, and we're still okay. As opposed to a true delta neutral strategy would really sort of lock the, you're basically betting that something won't go anywhere, and that that seems to be a much harder bet to make work. All right, if anybody has any other questions, that is all the pre-submitted questions. Thank you to, was it Scott, Jim, and Thomas for submitting those ahead of time. You can submit questions ahead of time. Just hit the help button on the website. You can say, hey, talk about this in the workshop. You can also reply to that workshop email that says, do you have questions about the stock market? I get all those too. And if you just have a question and don't want to wait for one of these workshops, you can also hit that help button on the website and send us an email, and we will answer it there. Just some housekeeping while I'm waiting for more questions to come in. This is being recorded. We'll post we'll post the video on the website tomorrow sometime, and also a link to the slides. One other note is the next workshop will not be 3 weeks from today. 3 weeks from today, if you can believe it, is the day before Thanksgiving. It seems crazy to me that Thanksgiving is 3 weeks away. So we're going to have the next workshop on the 30th, which will be the following Wednesday. So it's 4 weeks this time instead of 3, but yeah, nobody wants to listen to me talk for an hour the day before Thanksgiving anyway. So it probably works better for everybody. Dorothy, I'm not sure I understand your question. It says, where's the kid option posted? I don't know what that means. Okay, KKR, yes. So the example from Scott's question, that is from our Investors Keyhole service, which if you go to the options dashboard, it will show up under Investors Keyhole. KKR and Company upgraded to buy, so it's available there. Also, if you subscribe to the Elite Options, you should have gotten it in an email under this subject line. If you did not, you can go to message settings and make sure this is turned on. The blue means on, the gray means off. It turns out I write and edit these. I don't need to receive them by email, so I have all of mine turned off. But if you want to get them by email, you should have them turned on. All right, pretty quiet group today. Not a lot of questions coming in. I will give people a few more minutes to see if anything comes up. But otherwise, like I said, we'll send you a recording of this tomorrow if you're interested. Or, well, I guess if you missed it, you've watched an awful lot of video before you you heard me tell you we're going to send you a video. So, yeah, I won't say anything to people who didn't come today. All right, well, nobody seems to be putting in any questions, so I will go ahead and sign off. Thank you for coming. Thank you for subscribing to Investors Observer. This right here is that help button I was talking about. It's in this an email. We get back to most of them same day. So if you have any questions between now and the next workshop, which is November 30th, please don't hesitate to send us a message there. Thank you.